Are you making over $250,000 a year? Here are 3 ways investing in real estate can save you in taxes. The first one is depreciation. If you own a rental property, you are allowed to claim depreciation, which is considered a phantom expense, to offset the rental income that you are generating from your rental property. Residential rentals are depreciated at 27.5 years, and commercial buildings are depreciated at 39 years. One thing that a lot of people get mixed up is that your short-term rentals are actually depreciated at 39 years, even though it may be in a residential neighborhood. So residential buildings depreciated at 27.5, commercial buildings 39 years, and if you have a short-term rental, it automatically defaults to a commercial building, so it would be 39-year property. Within those properties, you have 5, 7, and 15-year property, which can be anything from furnitures and fixtures all the way up to landscaping, swimming pools, and sidewalks. Now, one thing I always warn my real estate investors about is depreciation recapture, because whenever you sell an asset like a rental property, and it applies to more than just rental properties, it could be even a vehicle that you may have depreciated in the past. Whenever you sell that asset, you have to recapture all the depreciation you took back as ordinary income. So just be mindful whenever you're going to be out there bonus depreciating, because if you end up selling your property back within a few years, that depreciation recapture could really come back and bite you in the butt. Number 2 is going to be real estate professional status. And I'm going to actually couple this with short-term rentals, because the idea of real estate professional status is to treat your rental activity as a non-passive activity. Now, I've said plenty of times on this channel before that your rental real estate defaults as a passive activity. Qualifying as a real estate professional can actually help you treat your activity as a non-passive activity, and this can be very strategic because if you draw any losses on your property, most likely thanks to depreciation, that would be a non-passive loss which you can then use to offset other business and W-2 income. Now, to qualify as a real estate professional, you do have to jump over several hurdles. You have to spend at least 750 hours in a real property trade or business in which you materially participate, and more than half of all the services you render in a year must be in a real property trade or business. There's some nuances to that. You can group activities together, but just that criteria alone, if you have a W-2 job, it almost makes it impossible to qualify for real estate professional status. Not only that, but you then have to materially participate in your rentals. Now, the workaround with short-term rentals is you don't actually have to qualify for real estate professional status. You only have to materially participate in your rental, which is not just a cakewalk by any means necessary, but it is a much less stringent test that you have to meet. Now, of course, in order to qualify as a short-term rental, you must have the average tenant stay for 7 days or less. That is one of the main criteria. There's a few other things that go into it, but remember, the idea of reps and short-term rentals is to treat your activity as non-passive, so you can then use any losses generated to offset your other income. Now, the next benefit applies to if you're not going to treat your activity as non-passive. You're just going to go ahead and let it be a passive activity. The next strategy involves passive activity netting. Essentially, if you could be a passive investor in a small business and you can generate passive income from that investment, you can then use your passive losses generated from your real estate to then offset that passive income. This is called passive activity netting, and it's a really great strategy that a lot of wealthy individuals use to really diversify their investments. They invest in small business and then they shelter that income by investing in real estate. This can be a really powerful strategy if you ever find a profitable small business to invest in.